Hello, everybody. Twofer, 2 in 1 day, and the Great Escape. I see you out there. Thank you all for coming. This is about the Great Escape as well. So this is going to be, I've done a couple of videos on DCA and steroids, but this is kind of a refresher. We're going to analyze about 32 different charts, maybe more, maybe 35. And we're going to go through results and see exactly if we can beat DCA and how we can do it. And this is a new session now every Friday. I'll be doing what I call my TA Masterclass, which goes way beyond just TA, but really leveraging tools to get ahead of the competition, because it's not so much being part of being an investor, but it's about being first. If you're not first, you're last, as they say. So let's jump in. Disclaimer that none of this is financial advice, of course, and if you want to amplify your intelligence, hit that subscribe button. So first of all, why? This is kind of the crux of what people sometimes don't realize, and how it is possible to beat traditional old DCA. First of all, there are fluctuations in the markets. Nothing goes straight up and nothing goes down. And that's because of these four factors. So supply and demand, for example, it's determined by the balance of supply and demand. I did a video over the last 2 days about supply and demand and buying pressure and how that translates to price. It is so critical for you all to understand. And the price of any asset is determined by that balance of supply and demand. If there's more buyers than sellers, price will go up. If there's more sellers than buyers, price will go down. And we now have tools to be able to assess that as well. It works for stocks, it works for Bitcoin, it works for commodities, it works for indices, etc. That's the first part. Second, investor sentiment. It's never steady. The mood of investors, that's why I always look at fear and greed, can have a huge impact on the stock and crypto prices. If investors feel bullish, they're more likely to buy assets and push prices up. If they are afraid, if they're feeling bearish, if they listen to mainstream media, they're more likely to sell assets, and that could drive prices down. Also, there's economic factors. That's why we look at the macro. The overall state of the economy can affect stock and crypto prices. If the economy is doing well, investors are more likely to be optimistic, feel like they're richer, they got more money in their pocket. If the economy is doing poorly, investors are more likely to be pessimistic and not buy anything. In fact, they'll sell assets. And finally, news and events. We've seen, again, MSM, how it is. News and events can have a huge impact on assets. If a company, for example, reports strong earnings or weak earnings or whatever, you can see what happens. Or if FUD is spread about a certain crypto. That's why these four things give us an opportunity to beat the market. And that's the whole crux of what we're going to go through today. I will do a couple of intro slides to really set the tone, and then we will look at the charts, I promise. Just bear with me 1 second. So first of all, can a model be built that beats DCA? We'll find out real soon, and I'll test it. Also, how do you do it? And which conditions, what market conditions, bull, bear, etc., which days, what strategy. We'll do a refresher on all that too. So a quick revision, in case you have not seen this before, you need to be familiarized. There is the old way of lump sum investing. You just take, say, $28,000 today and just buy one Bitcoin, or you invest a little bit over time. And a lot of people believe, obviously, DCAing over time is better than lump sum investing, which is a very highly debated topic in the world of investing. And there is an answer, and I'll show it to you today. But not only is lump sum tends to be risky unless you can nail bottoms of markets, which is good, and we like to do that as well. But DCA does remove a lot of volatility. And again, it all depends on exactly where we are in the market. If we have a huge kind of black swan event, like we had in March 2020, I was ready. And then I just put a lump in many different assets, all in the space of like 3 or 4 hours. I just went nuts. But I was expecting what was going to happen. And I was just waiting like a sniper in the woods. So then it can work. But let's talk about as well the situations in which it can. So for example, DCA during crashes can bring about exponential results, but lump sum also can bring about exponential results. So for example, if you look at the tops of the markets here, DCA outperformance, the green wins. But if you can do lump sum where the blue bottoms happen, that wins. So that really is the important thing. But overall, DCA actually does tend to outperform. But what happens if you can do better than DCA? And we call that DCA on steroids. Now, if you go to any, there's people that say, oh, it's impossible to pick stocks and it's impossible to beat DCA. Well, my job is to prove everybody wrong. This guy, Nick McJulie, he said even God couldn't beat dollar cost averaging. Well, we did. I had a vision and a brilliant development team. In fact, shout out to one of my key developers from Virginia. May have helped us make this happen and bring it to you. So with that, I think what we're going to do, the research plan today, I picked a whole bunch of assets. I tried to pick one of everything, whether it's complete poop or excellent, across everything from the Magnificent Seven to bad stocks, to scam coins, to solid crypto names, to indices, to gold. Went back 3 years to cover both bull markets and bear markets, and I used all neutral settings. And the plan was to DCA $100 a week and see exactly how these things perform. That was it. Now, the model we're going to look at, what we call DCA on steroids, it's real simple. It's actually not simple behind the scenes, but basically, this is kind of, imagine an asset going up and going down over time. At the top, when what we call the DCAS model, we have a name for it, we call it the squeeze. But when that's green, you nibble, you get a little taste. When you're under the line and it's green, you buy a lot. You amplify your purchase. You don't just nibble. When it's red above the line, there is no buy. When it's red below the line, there is no buy. The system tells you when you can and cannot buy, and most important thing, how much you buy. This is what we call the load. So for example, not only when to buy, but the load at which you buy. So for example, if you've gone, say, 2 or 3 weeks without buying anything, and all of a sudden there's a big dip in the market, the model will tell you to buy 3.19 times your normal DCA, which would be $319 worth if you are DCAing $100 a week. That's it. It takes all the thinking away from you all. And the question is, does it work? Well, let's go look. And we're going to play around with a bunch of live charts right now. It's a great day in the market. Bitcoin just at 28K still. It's been an up day. And then we'll come back to the deck and talk about the conclusion as well. So let me try and share my entire desktop. Yeah, let's just blow this up and see where we go. So let me make sure everybody can see everything. All right, so what we're looking at here, I'm going to punch through a list of all these names. We are going to go with this list, and we're going to start with alphabetical order just to keep things simple. I'm not going to sort these by stocks or commodities or indices or crypto till after we are finished. Okay, now this is kind of the scene that we're looking at, and we're going to go back to the beginning of the last bull market. Now within the DCA calculator, you have the DCA model here. You got your trading style. You can plug it in, make sure it conforms to what you have above. Very important if you are very aggressive or you're new to a certain product and you need to accumulate a lot, you can toggle that. Also within the DCA calculator here, you will have the results. This system also has a back test, which is right here in the white box. I'll walk through that as well in a minute. You can show the results. You can turn it off or turn it on. Very important. You got your display. You can have it turned on or turned off depending on where you are. You have label size large. I have it large because I can't see very well. It depends on how big your monitor, or you can turn it to small. I'll leave it at large so we can all see. And then you can have your strategy to DCAS or DCA. You can compare how they both work. I have DCAS on, and the buy amount $100. We'll do the frequency to the weekly going forward, and we'll start the clock. Let's go back 3 years. Let me get this right. Sorry, I was typing this in manually. Let's start before any of the fireworks kicked off last year. So we'll start at November 2020. So say nearly 3 years ago. You can also drag and drop this thing here, this anchor this way, depending on how you want to play. So real simple. Now, when we zoom in, you will see exactly what happens. So during times when the market's going crazy, like big red squeezes, it won't have you buy, but it'll wait for things to come back and revert. And then during times when the price comes down a lot, it buys multiples. And then it comes down more, it buys even more. So if we zoom in here, you can see some of these multiples are very high, like 2.97 and 3.13 and 3.07 and 2.67 and 2.59. But it will not make you buy during these up times, like I mentioned, that are driven by different assets. So let's go look at Bitcoin here. Now, what I want you to cast your eyes on is this little white box. You can back test your results. You can go and change any of the settings within the actual system. You can change the day of the week you buy. So for example, a Monday is typically the best, maybe Tuesday. The time, you can change your trading style to conservative or aggressive, and that will modify things. I'm just going to leave everything neutral for now. And market behavior, you can buy more or buy less. Imagine you're just getting into something like MicroStrategy or NVDA for the first time, or Tesla, and you need to build a bag fast. Then you'll toggle this to buy more. You just want to be on the train, and this will help amplify the actual results as well. So that's it. It's real simple. And then what we look at here is the actual performance of the model. So you got your ROI, which is if you just do DCA, since over the last 3 years, you would have lost 4.6% of your investment. You can see the way it changes to 4.5% because that means it's dynamic. It means Bitcoin went up a little bit. If you use DCAS, you would have made 17.5% on your investment. We went through a nasty bear market, so that is pretty darn impressive. You would also have 0.519 Bitcoin on DCA and 0.675 on DCAS. So over 2/3 of a Bitcoin on your way to whole coinership. And the amount that you spent is only $800 more, but you made much more ROI, 23% more return on investment. And that's what's important. And I'll show you a sheet later. We will collate all the results that we're going to go through here for all these different charts. So, okay, we're going to start with Apple, and we'll see how that performs. This one, again, a little bit different. You can see when it buys, when it sells. So the DCA is 18.8% return on investment, and DCAS 25.3. So not spectacular, but still beats it. Spend a lot less, get pretty much the same amount of shares. Let's look at Cardano here. This is kind of an interesting one. Here we see the ROI, if you had just DCA'd into Cardano, will be minus 43%. If you use DCAS, minus 11.5%. You lose a lot less money. And there's a key thing here. You would have bought 32,721 tokens if you're using DCA. If you're using DCAS, you would have bought 18,000. But remember, you only spent 1/3 of the money. Okay, so not only does it help you optimize your buy, but we have code in there that keeps you away from things that are trending down. We'll talk more about another model that we're working on right now called the ATR that determines when something is a zombie coin or not. We'll get there as well shortly. So that's Cardano. So again, you wouldn't have bought a lot, but you would have saved a lot. That's very, very important. Let's look at Amazon. And again, I took a smattering of a whole bunch of different names. Amazon. Here, you would have had ROI minus 3.5% under DCA, ROI plus 7.8% under DCAS. Again, you would have had a lot more shares and a lot more return on investment. This is Arbitrum. What's interesting here as well, you have the model running, but it doesn't buy you in. Again, it keeps you out of things that it finds, it sniffs out that it feels are dangerous, so you would not be doing any purchases on Arbitrum. Also, it needs a lot of history to calculate, so if it can't make a decision, it won't do anything. This is Bitcoin. Here, the Bitcoin ROI minus 4.6, DCA 24.6 on DCAS. A lot better. You would have spent a lot less money, $5,500 less money, and you've had almost the same amount of Bitcoin. Let's look at CleanSpark. Here, if you use DCA, minus 34.7% return on investment. You would have lost more than 1/3 of your money, and you would have had a plus return on investment if you use DCAS. Again, it works. Let's look at Polkadot. Another one here, very like Cardano. You would have spent less, and saved a lot more. So minus 54% ROI if you use DCA into Polkadot, and only minus 15% if you use DCAS. But you would have spent a lot less money. Instead of spending 15,200 DCA, you would have only spent 4,274. Let's look at Ethereum. This one is interesting. Minus 3.3% ROI versus plus 3.1% under DCAS. Let's look at Filecoin. And some assets are very interesting. This one also minus 61.6% under DCA, minus 9.9% under DCAS. Here, again, it keeps you out of bad assets, which is good. Gold, interesting one. Here, again, your ROI would have been 0 under DCA, but 1.8% under DCAS. Remember, if you divide gold price by the M2 money supply growth, of course, it won't be 0. It'll be a lot less. But the point is here, you spent a lot less as well. Instead of spending 15 grand, you're only spending 3,200. So again, it keeps you out of things that are laggards. Let's look at Google. Google here, 21.8% versus 29.1%. Again, DCAS wins. The graph, minus 50.7% to basically break even under DCAS. But you spent, instead of spending 15,000, you're spending $910. Hedera, this one is spending almost the same, but the ROI is minus 41% under DCA and minus 15% under DCAS. I did warn you all, it was a nasty bear market, and I'm just throwing everything in here. This is Hex. Hex, I won't say what it is, but you know from me in this channel. If you just DCA'd, you would have lost 81.7%. Under DCAS, you would have lost 55.4%. Remember, you would have spent 15,200 DCA and you only spent 5,900 under DCAS. Again, it kind of kept you out, which is good too. Lucid, another company, not good. It kept you out. You didn't buy anything. Good. Meta has been my top performing trade of the last 12 months. And it's up against a lot of very good trades. But here, DCA, 42.9% ROI. That's really good. But if you use DCS, 79.9%. You doubled your return on investment by using this model on DCAS. And you would have spent 15,100 versus 16,700. And instead of 68 shares, you'd have 95.3 shares. Note, when you have 100 shares, then you can sell calls, which is awesome. Let's look at Microsoft. DCA versus DCAS, 20.8% ROI versus 26.8%. Again, DCS wins. MicroStrategy, another favorite of the channel here. This one's interesting. You would have spent a lot more. You got a lot more shares, but the ROI is 0.8% just DCA and 4.8% on DCS. And this is an interesting one because MicroStrategy has been very, very volatile. But again, fun to look back on where you would have bought and not bought, etc. Remember this huge screaming rise here where MicroStrategy shot straight up to nearly $1,300, ladies and gentlemen, on that hype. This system kept you out from FOMOing in. That is extremely important, ladies and gentlemen. You don't FOMO into stuff when it goes parabolic. And everything mean reverts. Let's look at Near Protocol. Here we are with minus 57.4 versus 11%. Minus 11%. Again, it keeps you out. NVIDIA, interesting one. Let's see how this one pans out. So NVIDIA would be ROI 136.4% under DCA. That's incredible. But 175% under DCAS. You would have spent a lot more. $5,500, spent a lot less, $5,500 less, and you only have 20 shares less. So the ROI is a lot better. But again, the model doesn't like when things go up so high. But if NVIDIA was to mean revert, that's when it would have done really well. But it still beat it despite what actually happened. Let's look at Oxy. This is Occidental Petroleum. DCA ROI 61.6, DCAS 104%. Much better here, even on stodgy companies. But what you're seeing here is the more volatility there is, the better this tool performs. QQQ, this is an index, 11.7% versus 19.6%. Shopify, minus 11.3% versus plus 1.5%. Again, volatile beast. It helps you there. Solana, this one is 61.4% ROI versus 13.1%. But again, this has gone through an interesting patch. So here, what we need to do is change the time frame to when it started crunching, when the model started working. And then you can see here, because it hasn't been around a lot of time, but the ROI, when you start seeing the numbers here, 14.5 versus 15.6. So a little bit better, but you would have had a lot more tokens too, because it saw opportunity from the volatility. So play the volatility. S&P 500, let's go back to where we started, which was, I think it was 10th of November, where we put the anchor. We can just drag this back here. 10th of November. Make sure the results are consistent. Something like that. Okay. And if you miss a couple of days, whatever, it doesn't make a big difference. But everything is calculated based on this. So the ROI here for the S&P 500 is 4% versus plus 6.3%. Again, things like indexes, because they're so stodgy, as I call them, they don't move. They don't move violently like Meta does. But the more violent the moves, the more things shoot up and shoot down, the more money you make. Now, let's look at Tesla. Tesla, DCA is 13.3%. DCAS 19.3%. Very good. VGX, another example of keeping you out of something. It keeps you out of Voyager token. Veracity, this one is also very interesting. Hold on a second. Yeah, this one, because we only have data to here, we got to drag the anchor. Here, Veracity 30.3% versus 40.9%. DCAS. Let's look at Monero. Let's take this model back again. Again, you can just scroll it back here to, or you can enter the date manually. What I have, 10th of November, 2020. This is XLM, minus 25.1% on DCA and plus 0.6% on DCAS. So good result there. And finally, XRP. Choosing all the X's today. ROI 1.8% DCA and DCAS 27.7% positive. Huge difference. Very, very good result there. So there's some of the charts. Now, the other thing that I do want to show is, okay, we went back to, what was it, 2020? So we got all bear and bull markets in place. What happens if we drag this to the start of the bear market? Okay, that's 10th of November 2021, before we went back to 10th of November 2020 for all the other charts we just went through. So this is Bitcoin if we ran the clock beginning at the top of the bull, which means into the nasty bear. DCAS still beats DCA. DCAS ROI is 21%, and ROI under DCA is 5.9, 5.8% as well. And we'd have more Bitcoin and spent $1,000 less money. That is important. Now, there's another thing as well I do want to show you. We are working on this model, ATR. There's elements of ATR in the DCAS model, but this is very, very important. What I do is I look at things that I think the community needs, not only education, but also tools to help them get out of assets that are bad. So the ATR really comes up with what we call a zombie coefficient to determine the liveliness, or in this case, the death of a token. And you can see here, Hex is dead. And also, as we saw from the model, it keeps us out of it. When we turn on our DCA, pop this up, you can see here, it keeps us out, which is very, very important, at least as much as possible. If you do set your target on something, make sure it's a good asset. So use things like the ATR to determine. Now let's crunch all the numbers and let's look at everything we went through. So I started the clock 3 years ago and collated all the data. Let's look at category of, say, let's look at crypto first. And these are all the results. So what I have is Cardano, Arbitrum, Bitcoin, Polkadot, Ethereum, Filecoin, Graph, Hedera, Hex, Near, Solana, Voyager, Veracity, XLM, and XRP. And you can see here the DCAS return on investment is all there. If we sort them, you know, they're all kind of bad. And then I have the DCAS, make this a little bigger actually, if you can see that better. The DCAS, return on investment, you can see is a lot better in all cases. Every single case, no matter what time frame you choose, etc. And I didn't even go into toggling the settings to accumulate more aggressive, more bearish. With the back test, you can choose your time frames and you can choose your strategy, and then you can see exactly how it would have performed over time. And the delta and the ROI, the average delta for all of crypto is 36.05% better than DCA, no matter what asset it is. And then also the savings, and this is per DCA, the average saving if you use DCA for crypto is $3,770. Let's toggle as well to stocks for a second. This was interesting to me because if you look at some of the top deltas, so if we go to the top one, NVDA, it worked really well. Lucid, it worked really well. Oxy, it worked really well. CleanSpark, Meta, Shopify, even Tesla, it did better. But sometimes when things are crazy volatile, the model works crazy good. And again, it keeps you out of bad things and in good things. Also, the average return for all of the stocks using DCA is 4,743. You save even more with stocks than you do with crypto. But again, crypto went through a nasty bear, so that has to be taken into account. But even despite the bear market, the model does work. And then indices, just for indices and commodities, just for giggles, you can see here, because they're kind of stodgy, they don't move, but the DCAS delta is better for gold. It's 10% better for the NASDAQ and 6% better for the less volatile S&P 500, 5.9%. And the average index gain is $830, but we don't trade indices here for that exact reason. So I will share this spreadsheet as well later with everybody on Patreon, so you can see for yourself, and then you can modify this spreadsheet and model for your settings, for your assets. You can back test them and identify where it works best and under what settings and under what time frames, especially now when we have the luxury of looking back at multiple markets. So I'm going to now pop up this guy. So after all that, I hope everybody's still here. 27 minutes. Let's go look at a quick conclusion of all of this and drill into some information from the back. So conclusion real quick. First of all, this is a product we do have available. We just try and cover costs. That is kind of my mission, is to help the community as much as possible. It does cost $19 a month, but it optimizes your DCA, saves you a ton of money, and it makes you a ton of money, and it helps you avoid crap assets. So that is good, but always use the back test as well. There are some things that can be unusual, and also beware of bad assets. Be in good stuff that's going to go up, and don't be on things that are just have a zombie coefficient of almost zero. Not good. Also, the ROI, the delta results of DCA versus DCS over 3 years, over 35 different assets. Average of all is 28.58%. Average of stock, 24.58%. And the average of crypto is 36.05%, which is very, very good. And for those on the road, this is from our Patreon member, Mr. Mike, who has to travel a lot for work. So he has the alerts pop up on his iWatch. So he knows exactly when he needs to buy and how much load he needs to buy, even if he's on the road or in an airplane or whatever else. In addition, just to mention here, it does work in all three market scenarios: bear, bull, neutral, which is very, very good as well. And I forgot to mention as well, the model is at Investanswers.io. There's a link below, and there'll be a link up here after this video is done. And probably the most important thing, this is kind of so important for you as investors. Even if you choose to DCA into a certain asset, if that asset is bad, it will prevent you from spending too much money on it, okay? That is critical. It'll keep you away from bad assets. Nothing against donkeys, but donkeys are beautiful and cute, but not necessarily something you want to hold in your bag. So with that, big thank to everybody on Patreon, the one place for everything you need if you're interested in investing and becoming better. got the biggest finance community on the planet in Patreon. So thank you all for being here. Hope you enjoy the content. I'll see you tomorrow for the week recap. And good night, everybody. Sorry for being late. Big day. And Bitcoin is still above 28,000, which is awesome. We like that. All right. Good night, everybody. See you tomorrow. Thank you as well to the mods in the chat and everybody here. And a big shout out to PDOT. Hope, and up in Canada, I hope that doesn't stand for polka dot, because DCA didn't like it too much. Anyway, thank you all. See you all tomorrow. Bye.